Welcome back, everyone. Mike McCleary from Marine Money. Nice to see everybody again. And it's my pleasure to introduce and open the second session of the return to in-person conferences in New York for Marine Money. Often, including today, we have panels that focus on different types of capital, like credit or the IPO market. They look at current terms and conditions in that sector and highlight the various products and the providers of that type of finance. Up next, we have the opportunity for a broader discussion from the perspective of a single entity. One of the few, if not only, institutions that does it all. Of course, that's DNB. It's my pleasure to introduce our moderator, Jeff Pribor, who's uniquely experienced and qualified for this assignment, bringing his perspective as CEO of Seaways, formerly CFO. And Jen Martin, that's not an announcement of any kind, as well as his experience in investment banking recently as Global Head of Maritime Investment Banking at Jefferies. Before that, maybe fair to say a little more before that, in leadership positions at ING, Barings, and ABN AMRO, and perhaps particularly relevant at DNB Nor Markets, where he was Managing Director and President from 2001 to 2002. Thank you, Jeff and Pam.
Thanks very much and for that almost promotion. Is this on? Okay, hi. And our CEO, Lois Rocky, sends her best from the Middle East, which is doing her job meeting important oil tanker customers. But she'd love to be here today. But let me introduce on the panel this morning. This is my right is Evan Uhlick, who's the head of Ocean Industries for North America, which means shipping, for DNB, which means shipping, energy, including offshore, and I guess fish because they swim in the ocean, right? So fish. And Ted Jadick, president of DNB Markets Inc., which is their investment bank. You all know what that is, but to be clear, investment banking means half the people that work for you are corporate client-facing, like clients like International Seaways. You also have sales and trading, and those people face the institutions, right. And the investment bank is meant to bring them together. So that's the stage. And the other thing I want to say before we start is I don't know what possessed me to say yes to doing this, right? So, I'm a client. I have a couple of other banks, right? I mean, let's get one thing out of the way first. Is I did work, as Mike said, I did work for DNB for 2 years. I was the first person in Ted's role. I'm very proud of it. I'm very proud of what the bank's done. I found it's not exactly a pitch book, but it's a book. It says, it doesn't say DNB Markets Inc., it says Den Norske Bank. Yep. And I always write on the side of these things. Greek private companies, and this is from a trip that we took in 2001 to Athens with, I don't know who was with me on the trip, but there's a couple of names in here. How about Angela Koussis to start? Maria was just here. It's Lavanos, Chandras, Eastmed, Lasquidis, Latsis, Onassis. You were spot on. Yeah. So, I did work for DNB, but doing this, I've already heard from the CFO union has called me a scab. It's worse. The other banks have called up, but I said to them, hey, look, you could have sponsored Marine Money, and you did. Here we go. But it's not going to be an advertisement for DNB. We're going to talk a little bit about the model. I'll get right to it. I was happy to be a part of the creation of the U.S. investment banking part of DNB. But we'll talk about that and how the model's evolved. But we'll use that as a platform to talk about issues that are important across shipping, capital allocation, the availability of capital. What's the future of capital as we're cognizant of ESG and other important issues. So, but let's start with level setting. Evan, take us from wherever you want. Let's say the financial crisis to today. Just how has DNB's model evolved from what was a commercial bank, or maybe the JP Morgan State Bank of Norway, whatever you want to call it, but to what you are today. And walk us through that.
Well, thanks, Jeff, and congratulations also on your promotion as well. First of all, I know this has been said before, but it's just so awesome to be back and just to see folks again and reconnect. Really very in awe of everyone that's here, and great to be back. I joined DNB April 1st, 2009. I remember that quite well because it was really the high watermark of our overall shipping portfolio at the time, which I think was a bit of a Norwegian state secret, but it topped out at something like 25 or 28 billion, and it was enormous. I mean, that was just an enormous number, and the whole roaring 2000s featured breakneck growth of the portfolio. It featured, a space race with a fierce competitor of ours, and these large syndicated credit facilities, which were effectively, 80% kind of leverage deals with, I would say, not too taxing covenants with global banks, German banks, English banks, U.S. banks, Greek banks. It was quite a bank-focused capital structure, and then you could even maybe get another 10% of mezz just to top it up. And I think from that very high watermark, what we've seen is almost just the dismantling of that former bank debt-oriented capital structure for a variety of reasons. One of which obviously is dramatically increased regulation that the banks have had to go through. The other, in combination with the regulation, is just higher capital standards. But good old-fashioned losses definitely played a role in banks' overall appetite. And I think, the volatility of the segment has also steered many away. And I think what we've seen, what we've witnessed, is the capital structure morphing into a much more diverse, much more institutionally oriented vehicle. And I don't necessarily see that as being a bad thing. And I think about all of the different folks that are in these rooms today, capital corps, leasing houses, different types of alternative capital providers. And you've gone from what was, one model of international bank heavy balance sheets to a much more diversified puzzle. And I think through that trajectory, DNB has also changed its capital structure from being, one of the biggest, if not the biggest, I'm not sure if it was HSH, but one of the biggest providers, to being more of an arranger of capital. And we've done that successfully, we've done it unsuccessfully, and I think we've had overall reasonably good results over the years. And I think that's where maybe I'll park it, unless my colleague Mr.
Well, let me ask Ted,
Yeah.
tell us about Markets Inc., how it's evolved from the beginning, like 20 years ago, as an idea to provide more investment banking services. Tell us what you're doing today. Again, not an advertisement, but it'll help to set the stage for questions I'll ask you about the markets.
Thank you, Jeff. This is good. Yeah.
We hear you.
It's really been a nice evolution. It's taken time. We started really as an advisory house primarily. We didn't really have the sales and trading side at that time. So the relationships on the investor side were really not a part of the business model. It was very much driven by advisory, and it was very focused on shipping, very focused on, say, offshore drilling. Some of the sectors that DNB as an institution, it is very close to, has had a long track record in, and are particularly focused on outside of Norway. And that began to change, I would say. I took over the role of running the broker-dealer in 2010. Shortly after that, we really began to put some real effort into building the sales and distribution side of the investment bank, and really establishing relationships with institutional clients. And that really began to put us into a position where we could deliver other parts of the capital structure away from the bank debt piece. And that is basically where we are today. You said it pretty correctly on your introductory comments. It's basically a team that's 50% on the origination side, so the investment bankers, and a team that's 50% on the distribution side, being the sales and trading people. And then it's just about improving your business, growing your customer relationships, both on the corporate side and on the institutional side, and at the end of the day, you've got to deliver for the client to be hired, and that means you need to deliver good advice and good solution, and then you need to be able to execute on it.
So Evan, you said that you evolved from an era where you and some other banks were just in the space race to try to lend as much as possible to a completely different model where it's more selective, being an arranger, but providing capital. You know, you do make loans, right? So you've got Ted there with a suite of products from equity to debt to M&A. That's investment banking. You know, is there a hierarchy of products, or are you pushing some more than others, or or let's just put it another way, do you like making loans, or is it just a necessary evil to feed Ted's business?
I think it's a great question. The way that I like to describe it is the senior bank debt relationship really anchors the broader client's dialogue. It's a starting point. It's really getting on base. There's annual reviews. There's an annual credit process. There's anti-money laundering checks. It allows the bank to really get connected to and engaged with the borrower. And I think that is the wellspring or the base where we can better analyze the customer, better understand the customer's needs, and try to figure out how to serve the customer's needs. And so defining it as a necessary evil, I don't think is the right way to go.
I was hoping.
In isolation, the pure lending relationship is not our model. Our model is a diversified and integrated corporate investment banking model where we try to serve our customer in the best way possible through all of our different products and services. But in the immortal words of Tom Brady, we're still very much here. I get feedback from our clients that we're generally a little bit on the more expensive side than others, and that may be. But again, we're still very much here. We still very much want to put capital to work for sustainable borrowers.
Can I just comment on that as well? As we try to build and have built the investment bank, kind of a goal would always be that we would be in a position to be hired by a client, irrespective of the bank's balance sheet being in play or not, so that we would be hired because we can deliver good solutions and execute them. That being said, we are at our most effective when we can combine side and the investment banking side in solutions that really bring something a little more holistic to the client. So we're joined at the hip. That's just the way it works best.
Yeah, well, and the client side, that we never like to hear, you're lending us money, so we expect this services to come along with it. We want
you've got to be able to deliver.
You got to have quality across the board.
You've got to be able to deliver.
Absolutely. So let's move on to some of the topics that are of great interest to financing shipping in general. So let's talk about capital structure, for example. There's a lot of discussion about whether it's best to run, or there has been over the years a discussion that continues about, well, what's the best way to structure my balance sheet? Should I be high leverage and high return equity, or low leverage or even no leverage and high dividends? As you described it, you've moved from a pure, at least in shipping, a primarily provider of debt capital to an advisor and provider of capital. So what do you tell your clients? This is a question for either one of you. What's the optimal capital structure, or is there?
I think it was covered in a really good way by the first panel this morning. I think capital allocation is really the fundamental issue today for shipping. Not saying the shipping is any different than any other sector, but it's increasingly important and in focus. And that's because you need to have, and I think the advice we would give clients is, investors want to see a moderate leverage. They don't like the 60 to 70% leverage that the shipping industry used to run as a matter of course if you go back 5 years, 10 years. Why is that? It obviously puts a squeeze on the ability of a company to return money to shareholders. It potentially puts a squeeze on their ability to invest in the right time of the cycle. So I think moderate leverage, and how you exactly define that is maybe case by case. But it's a very clear message that at least we're giving to our customers.
I mean, ultimately, if you think of the bank as an intermediary, and you differentiate between what an equity investor is looking for and maybe what a debt investor is looking for, I think the key buzzword today is sustainability and being able to cover your fixed obligations or representations that you made to the market. And I think running at a lower overall gearing, albeit maybe without amortization within that leverage, allows shipping companies greater visibility on fulfilling a lot of those obligations.
Yeah, Evan, you cover other industries besides shipping. You know, I think we get pretty myopic in shipping, and we talk about NAV for everything, whether it's net asset value for everything, whether it's a share price or leverage, is always seems to be described as debt or net debt to NAV. But do you see some trends in debt to EBITDA and in energy that might be translating to shipping? I think that's. I like to think in terms of sort of mid-cycle EBITDA having appropriate leverage to that. Do you see that?
Look, within the broader hydrocarbon industries, which I cover on behalf of DNB, we're talking very close to near-death experiences for large swaths of the companies that operate in these industries. I mean, if you look at the offshore energy segment, even seasoned restructuring bankers were taken aback by virtually all of the companies in that segment going into bankruptcy. And the same could be said about the U.S. Oil and gas companies within kind of the small to medium size space. I mean, it's multi-decade levels of bankruptcy. And I think folks have gotten religion after these near-death experiences. Within the small to medium-sized oil and gas space, the buzzwords these days is 1 to 2 times net debt to EBITDA, and these are substantially lower levels than where folks were used to running at. I think again, out of these last few years, and I keep using this example of the fourth quarter of 2019 and just the absolute eruption of ESG mania that happened at that time, to the kind of 2021 period where it morphed into energy transition. People are very focused on lowering that overall quantum of leverage, creating more substantial, sustainable structures, and looking at, I think, opportunistically at consolidation and M&A in this next phase.
Yeah, so the reason I asked that question, and your answer is fascinating, is it goes to the next topic I want to address, which is capital availability for shipping. And that can be both on the lending side and particularly on the capital market side. First of all, on the lending side, I think there's a perception that the banks just have money and they lend it or don't, whereas investment banking is going to the institutions that your sales and trading people, whereas that really nothing can be further from the truth. So funds have to be sourced from somewhere. It's just in one case, the bank's the intermediary, but you have shareholders, and in another, you're going to the institutions. But in either case, let's talk about the availability of capital for shipping. First of all, let's hit the bank side. We always hear that the pool of bank first mortgage lien bank capital, lending capital is shrinking. Is that true, or is that just an old saw and it's being replaced by other sources in Asia or elsewhere?
Well, first of all, if you look at some of the transactions that have been completed in 2021, we've had a number of major North American companies really across the different subsegments that have gotten bank deals done, right? And I think it's a testament that there is still very much bank appetite. There's still very much a core cadre of banks that are still focused on the segment. And if I dare say, the levels were fairly attractive that a number of these companies got deals done at. And I think that also speaks to some of the pent-up demand that banks have to put capital to work. I think where the trouble gets in and where we haven't really tested is going to market with a traditional billion-dollar syndicated loan financing with a number of key tiers and a much more formal process. This was what we used to do in the big bank meetings, syndicated meetings, and I question how much overall quantum of capital is available. You can get 200, 300, probably even a $500 million deal done fairly easily. Once you get into the billion range, finding and securing that capital is going to be more global and it will be more expensive.
Yeah, but we're gonna need to get back there, aren't we, if there's gonna be consolidation, you know? We're only thinking in terms of the, you know, what's the max exposure one bank can have. So it's $1 billion deals, and then how much can any one bank have to any one client? Those are, we'll have to push the boundaries. But hey, Ted, let's talk about the capital markets. It's one thing let's go from lending to, is there capital markets money, debt or equity for shipping? Of course, there is some, but you know, if we go way back, and you and I kind of go way back, I mean, when there were only a few public shipping companies, pretty sure you remember that, Ted.
Yeah.
We're contemporaries, right? And there was, you know, the 80s, we had Stoll come out, and then the 90s or some more, and now there's a pretty robust number of shipping companies, but yet they don't trade a lot of times as well as all of us would like. Certainly we're trading below liquidation value. It's very frustrating as a management team. Has shipping disappointed investors, particularly on the equity side, such that there may not be any more IPOs, or it may be difficult to raise money, or what's the way forward then?
I think the way forward to me is again a more sustainable financial structure overall, which allows a company to relatively consistently or consistently be able to return capital to shareholders. The traditional long onlys that have actually funded this industry for many years, not many of them are still having skin in the game these days. I think it's important to get them back, so that's an effort, and I think that's part of what this sustainable capital allocation strategy is aimed at achieving. You heard that from some of the panelists today. We have to attract new investors as well. The capital markets are awash with investors. In the markets today, there's plenty of liquidity on the equity and the fixed income side. We are meeting new investors literally almost every day, and particularly in the kind of market we're in now, when markets are good and companies are cash flowing and share prices have appreciated. At least in certain of the sectors.
Yeah.
So
it's coming.
You'll get your chance. But I loved Maria's comment about her father saying the glass is half full. That's my attitude. I think you have to have that kind of an attitude when you work in a business like shipping, which, as we all know, has these roller coasters, and it's up and it's down. And I think one of the things about DNB is we don't recede when the market's lousy. Our customers need us in lousy markets, more or less as much as they need us in good markets. So, but it takes a real effort to have the kind of dialogue and contact with investors consistently, and then deliver performance, which is backing up what you're telling them. So I do think it's there, and just say really quickly, the bond markets. Okay, the U.S. bond markets haven't probably been as supported, but the Norwegian bond market has been an incredible, tool, market, vehicle for shipping and energy, hydrocarbon-related companies to raise a lot of capital.
Yeah, and the U.S. bond markets, larger tickets anyway, so we really haven't tested it very much, although it's beginning to happen. Mm-hmm. So, takeaways for the audience. If we're going to attract capital, further capital to shipping, low leverage, moderate leverage, look, maybe test some of those other metrics like EBITDA. Or if I want equity from the market, I have to promise to give it back, which is but at least return some of it on a regular basis. I think that up to. Then with only a few minutes left, let's talk about the future. Obviously, another filter for attracting capital is going to be the shipping industry stance on climate change and ESG. So everybody's concerned about it. It's not something that is new to anyone in this audience. But how is it affecting your perception of how capital is allocated from your bank or from institutions? And since there's only a little time left, make sure you tell us, Evan, if you think that's changed in the last period of time. Just in the last couple of months.
The importance of climate change cannot be denied. The importance of the shipping industry, the maritime industry, being on the right side of good here, reducing emissions, promoting efficiency within the operations, and not just that, but the governance elements as well are critically important. We have within our own process climate change questionnaires at each company. This is a very important part of the process. Having said that, I do believe, and we've seen this over the course of this fall, particularly with the energy crisis that we're seeing and the very elevated prices globally, the pendulum swing back to a more appropriate and normalized level. Hydrocarbons may not be as dirty or naughty as people made them out to be in 19 and 20, and I think people have come to an uneasy truce with hydrocarbons overall, and that's putting it in a nice way. And I think there is a broader both bank and investor appreciation of the important role of hydrocarbons in the many decades to come, which I view as positive for our industry.
I would certainly agree with that. I think it's our experience, and this is really more in the dialogue we have with investors. The pendulum had swung out quite a long way, and conversations tended to be very black or white in terms of where somebody stood. I think there's a lot more gray now. I think some of the events of the fall and where some of the commodity prices are currently are really having people think again about this and have a higher level of appreciation for the role that hydrocarbons are going to play for some time to come. And yeah, I think it has definitely colored people's views.
Good to hear. I mean, every ship owner whatever sector they're in, is concerned about their emissions because you have to propel the vessel, whether it's a container ship or a dry bulk or a tanker. Some of us, in the tanker and in the dry bulk space, carrying carbon resources, are concerned that no matter how much we're trying on the way we operate our companies to be good actors from the ESG sense and admit, let's get to zero, we're still intrinsically, the thing we do is move carbon. And maybe a lot of people may not know this, but if you do a knock bond, tell me if I'm wrong, Ted, you can't get investors from Sweden if you're a carbon mover, right? You can have a very successful knock bond, you've done a bunch, but you've got some people that say, well, I don't care what you're doing in ESG, you're in fossil fuels, so you're out. And I hope that pendulum swings back.
It's correct what you say. There are certainly some investors, and a number of them are in Sweden, or have a very, it's still a black and white issue for them. So that's John. One more comment I wanted to make, if I could, and I see we have all 3 zeros on the screen.
Time for the last word.
But it's about availability of capital for shipping, and we were more, and I was maybe more talking about the public markets. We've had 3 significant take-private transactions, this year. All of them in the LNG space, which I think is interesting. But you've had Höegh LNG, you've had GasLog, and you've had TK LNG in the process of being taken private. There have been significant amounts of capital, paid in to make those transactions happen. So it's not always all about the public markets.
Sure. Well, it's equity one way or the other. It's maybe not public, it's private.
Yeah.
Evan, any last words from you before we wrap it up?
I'm just very excited about, I think, the more normalizing that investors and banks have viewed the broader hydrocarbon markets that really has started this fall, and I'm hopeful that good things will come from that.
Right. Thanks very much, both of you, for your time.
Thanks, Jeff. Thank you.